Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, February 11th, 2019. This video will be part two of the transportation sector analysis. I covered in the first video, covered IYT and the 20 holdings within IYT. IYT is a transportation sector ETF. I touched on crude oil briefly, showing you some near-term developments as the transportation stocks have a pretty high correlation with crude. And in that video, I focused on the intermediate term outlook, the short to intermediate term outlook via the daily charts. And as I stated in that video, I think it's critical in one's analysis to keep the bigger picture in mind. And I don't think enough traders do that. I don't think enough professionals. And I, read articles and watch these people come on TV, in the press. They're focused on near-term developments, market breadth. And again, I pointed out the divergences in December, and I was looking for the rally that came. That rally was clearly priced into the charts. We're extremely oversold, strong divergences on a lot of individual stocks, individual sectors. And so the rally, therefore, although, it's certainly gone to the higher end, especially without a decent correction. I will say that. We're about where I expected it to go from the beginning, but I thought we'd have a sizable correction in between before we got there. And so that's about the only thing lacking. But again, it's not that it came out of nowhere. I'm a firm believer in technical analysis, and that's why I'm going to cover these charts and tell you what I see and what really shapes my bias going forward. And that is the fact that, as I just said a minute ago, go back last 10 years, we've been in a bull market since March 2009. On most sectors, as well as the broad market, you rarely had the weekly RSI come down and hit the 30 level oversold. You only had a few divergent lows, and those were great buying opportunities. When you have oversold in a bull market and you have positive divergences, those are usually great buying opportunities. And we had those recently. We had those at the December lows. Now, the $1 million question is, and this is what I mentioned in the other video, is are we in the early stages of a new bear market? And if so, then what you can expect is oversold. You'll come back down and take out that oversold readings again, become more oversold. Divergences will play out as they have, but not nearly for the move that they play out in bull markets. So really a bear market is a bull market in reverse. In bull markets, overbought tends to become more overbought. Well, this is a monthly chart we're talking about here, but the same premises apply on a daily chart. You tend to become extremely overbought and stay overbought for an extended period of time, whereas oversold readings are usually fleeting. In brief, you get a tag, one and done, and that's about it. Now again, let's talk about this chart a little bit, and I will get to the transportation. But this is again driving my overall outlook and causing me to dismiss or not put as heavy a weighting in certain things like the strong breadth that we've had off the lows, or at least in recent weeks. The fact that the 200-day and some key moving averages have been taken out. It's this that tells me, at least for the time being, these longer term sell signals that I received over the last month or two override and really paint the bigger picture where we're most likely headed. Nothing is 100% in technical analysis, but the day I stop using the charts and trusting these, clear sell signals is the day that I should just hang up my hat and do something else. So what we're looking at is this goes back to the 70s, the mid 70s. It's a long-term chart of the S&P 500, and what you probably can see here is there's only a handful of divergent highs that we've had on that monthly time frame. We had this one leading up, and this started with started going down before the crash of 87, but we had a bear market back then. It was 36%. It was swift, over before most knew it, but it was there, and it was certainly a bear market, and it was certainly preceded or priced in by the technicals, or indicated that. Fast forward to the dot-com bubbles. This you're looking at right from here to here is the strongest bull market in the history ever. This is the longest bull market, and this one is about to overtake that one. If we continue to push up throughout this year, we will have broken the record. Records are meant to be broken. Maybe it'll happen, maybe not. But there is sort of a mean reversion thing that plays in here, that There are averages, and we are certainly on the extreme end of an economic expansion and a bull market. So factor that in. But you can't short just because something is past its average length. But what I can tell you is that leading up to the 2000, the highs in early 2000, we had clear negative divergence on the RSI, and a lot of other indicators. I don't have them all up here, guys. I could put on the PPO and tell you this, and I'm not trying to cherry pick and make this chart tell me what I want it to say. I can tell you it's a clean bearish wedge leading up to the dot-com bubble. Huge bear market that followed. We had a divergent high. It may not look like much because we're looking at a monthly chart here, but that's clear negative divergence leading up to the highs in late 2007. There's the Great Recession and the bear market that followed, a 55% drop in the S&P 500. We had this that many market participants, technicians, whatever, consider a bear market. The S&P 500 just missed, as did the Nasdaq, just missed the 20% designation, but the small caps, the mid caps, most sectors dropped 20% or more, and most people consider that a bear market. Warren Buffett was famous for once saying, "If it's not a bear market, what is it?" Referring to poor market action. Market traded sideways to down for almost 2 years. So again, take it for what it's worth. But here's going back 30 plus years of chart history, and you look for these divergent highs. They are not common, and when you get them, they typically mark the end of bull markets. And so that's that. And then you have, of course, a divergent high in itself is not a sell signal. Sell signals come on the break of well-defined trend lines if you have them. And in this case, we had this primary bull market uptrend line has been broken and back tested when I zoom in. Finally, you have the 20-month EMA. I've covered this all in other videos. It's done a great job at defining bull and bear trends. When the S&P 500 is below its 20-month exponential moving average, the trend is bullish. Once it breaks, that then becomes resistance, and this is the entire bear market. Again, doesn't look like much, but that was a huge bear market, as was this one. So we are now back testing. After taking those out, we're back testing the primary uptrend line. This monthly candle right now so far is a hair above that. But again, you will get whipsaw signals, a little bit above, a little bit below. And again, this monthly candle is only in its early stages. It doesn't matter until we close the month of February as to where this candle closes or not. So there's my longer term outlook. Oh yeah, and then finally, and again, one of many long-term trend indicators, the ROC 12, rate of change 12, does a great job of defining bull and bear markets when it goes red, and it's gone solidly red. Not a little whipsaw signal like these two back here, but solid two red back-to-back bars. And again, these are just reliable, fairly or highly reliable long-term trend indicators. And so I wanted to say that helps to shape my longer-term view. Now let's dig into the charts of IYT, that is. All right, so what do we see with IYT? I'm on a monthly chart now. I stuck with the monthly time frame. A couple things stand out to me. Number one, there's that good old ROC 12. Does a better job on the major indexes because you can see a few more bars, and sometimes I'll play around with the ROC 12. I'll take the numbers and see which one fits a certain index or sector better. I might move up to the ROC 13. You can play around with it like that. I'll just leave it on the ROC 12 now because that's what I had on the S&P 500. So here's IYT. Trading history starts back, it looks like late 2003. So that's as far back as we can go there. And you can see we've had 1, 2, 3 major bear markets in IYT. They were all confirmed with the ROC 12 being red, those histogram bars flipping down. That was a bad, very powerful bear market, as was that. And what this is telling us, again, guys, anything is possible. Maybe it's a little brief whipsaw signal, but this is early stage. We have two solid. Those are beyond whipsaw bars. They're deep red bars. February is only early in the month right now, but the bar is still red, telling us that the primary trend is bearish. And you can see when you look above, remember the trend indicators are useful to help to confirm what you see on the charts, but I really like to go by trend line breaks, key moving averages, things like that that act as support or resistance. So there's our breakdown. And to me, again, this looks like just early stage um, bear market, if you will, in the transportation sectors. Oh yeah, the other thing, go back to 2003 since IYT started trading, and what do you have? You only have two very clear, unmistakable divergent highs on the PPO right there, or the RSI that is. I could probably put up a PPO and show you the same thing. So there it is. We had a little bear market here, but the big bear market came back here. The 2007 top, or actually the transpose topped in early '08, and then the bear market came, and I'm seeing very similar technical pattern right now to back then, as with back then, excuse me. All right, weekly chart. IYT Weekly speaks volumes to me. Very clear, clean lines on this chart. You have the, again, we're going back all the way to '09 right here. There is a bearish rising wedge pattern right there, confirmed with negative divergence, bear market. There's a breakout right there. There was a nice downtrend line that led to a nice rally there. But you can see here we had a pretty decent uptrend line. We certainly had some clean negative divergence. Again, it's a wash, rinse, repeat thing. Look for these divergent highs. And again, this is a weekly time frame. So this isn't where you hone down your entries and exits. That's on the 60-minute chart I showed you earlier. I showed you a bearish rising wedge on IYT 60-minute. This is what formulates the bigger picture. When you see multi-year divergences forming on the transportation sector or any sector index, that tells you you're not looking at a swing trade that might last a few days to maybe a couple weeks. You're looking at a trend trade. If you can get short, if you can stick with that trade, maybe scale in, and also it will help, like right now, to formulate when you get the bounces. Okay, am I going to look to go long, or am I going to look to trade that bounce maybe quick, get out long and reshort on a bounce back to resistance? In this case, that was the 200-day EMA, which has just done a great job. You can see the 200-day defining the uptrend. 200 broke, and it then acted as resistance. And so you had a nice shorting up there in that rally back to the 200-day. So where are we at now? Well, we've come full circle. We have a well-defined uptrend line off the early 2016 lows, terminating with a rising wedge pattern there. Very clear negative divergences. And there's the first leg down, the breakdown. Your sell signal came right there. Kickback rally one, another leg down, and kickback rally to the 200-day, just like I just showed you right here. Kickback right here to the 200-day. All I can tell you is it is objective to short here. This market may be going to the moon, and you're not going to ride it to the moon if you were to short there. You short there, and I know it gets tough in a volatile market with big price swings, especially when the momentum's to the upside. So you either have to give your position some room, or what I like to do, if you are scaling in, if you are taking the longer term mindset, and you think we're going to go down and undercut those lows, then you can scale in, take fractional positions, and add. Don't add if it keeps going up and proving you wrong, but you can continue to add if the trade starts to go in your direction. That's what the professionals do. They scale up on a winning position, not down on a losing position, or they add to a winning position as the trade confirms that they were correct. Even Jesse Livermore, he's famous for doing that as well. So there it is. What else can I show you here on the weekly chart? Well, there's my tried and true PPO signal line indicator, the white line, not the blue one. The last of the two to cross is a white line. It said bear market from here to here. Yes, bear market. It told you here we crossed into a bull market. We had a little slight whipsaw, but for the most part, you can see that it is traded above the zero line all but for this period, which was a bear market. Where are we now? Solidly in bear market territory, and early in the bear market by this indicator. Here's those RSI readings. Now let's look where they came real quick. It came right here. Let me do crosshairs. Yeah, we'll do crosshairs. So that one came there. It came before the low. And so what happened is the end came after that correction on a divergent low. From this point, that's where that oversold reading was, to this point, you had positive divergence. That told you to get long, not at the first oversold reading. Right here was a one and done. I will say that. And there was your oversold reading, and that marked the bottom. Here we're oversold. $1 million question. Is it a one and done, or, which I favored, we come in and put in a divergent low like this with the RSI coming in at higher levels? Uh, that would be preferable. It's not necessary, but preferable. More importantly, we're at resistance. There's that 200-day, like I just showed you, the red line, the 200-day moving average, and there's price resistance right here. So what I see is that what looks like a big topping pattern right here. It's like a basing pattern in reverse. Multi-year sideways trading range, about a 1 year long sideways trading range, and we're just now rallying up to the upside or the bottom of that pattern. Okay, now let's dive into the charts. I've kind of laid the groundwork. I spent a little more time, obviously, on IYT because it is the sector itself. If you are going to go long or short any of the individual stocks, I like to use a top-down approach in technical analysis. What does that mean? Well, number one, the top would be the market. I just showed you the S&P 500. So if I can make a bearish case on the market overall, if I can make a clearly bearish case, or at least a decent bearish case, I should say, right now, because again, there are some indicators that haven't flipped, but I just made a bearish case longer term on the broad market. Then I drill down to within the broad market, you have a sector. You're not going to see IYT drop 30-40% with the S&P 500 going up 30 or 40. It is a subsector, a component of the S&P 500. Therefore, it can go in different directions, but for the most part, you want to align your trades with the broad market as well. You want the tide flowing with you or the wind to your back, and so that's a top-down approach. What are the markets doing? Then what's the sector doing? Then finally, what are the individual stocks? So if I can make a bearish case, long-term case on the S&P, and I can also make a decent bearish case on the transportation sector. Then I go in and sniff out the most bearish stocks within there, and I will most likely outperform by shorting those and avoiding the most bullish stocks. Okay, we'll go through these a little quicker because I promised this video would be shorter. Here's UNP on a long-term chart. We're going to stay on the weekly. I might jump to a few monthly charts, but I'll mostly stick with the weekly on these. There it is. I mean, that's pretty clean. We had an uptrend line here, a rising wedge, and that was a bear market, not just a correction. It was a drop of well over 20%. Came with a divergent high, and then you had a divergent high here. Let me jump over to a weekly. That's 6-day period. It's about 10-year right here. So there it was. Again, divergent high. You don't get many of these. Yes, we've been in a bull market overall in the broad market, but these are bear markets, very profitable trend trades, and very clear, unmistakable sell signals, in my opinion. There was a very well-defined trend line terminated. Again, a trend line was going for a while. You don't look to short until you start to see these divergences forming. You had clean negative divergences at the high. I should add this right here. That's where it terminated. The divergences ended there when prices peaked, and then boom, bear market. How much was that? Well, let's just hypothetically say you nailed the top on it. You saw the divergent high, and you anticipated the trend reversal. You're good for about a 40-45% gain. And here we are again. We've come full circle. You can see there's a relative frequency. It's not exact between these bear markets or these corrections, and we're about there in time right now. And there's your uptrend line. We popped slightly above it. That's something to monitor, but again, it's more of what the sector will do, and that'll determine if this one plays out or not. So I'd really like to see UNP reverse soon because again, it's snapped just above that trend line, but sometimes you have a little bit of wiggle room there. Here's UPS next up. And we had a divergent high back here followed by a correction that took us to this primary uptrend line. So this is the most significant level right now on this long-term weekly chart. We didn't have a divergent high this time around, but we had what appeared to be a blow off top of that near vertical move up followed by a sharp correction down. And again, most importantly, we are back testing a pretty well-defined trend line that goes all the way back to 2009. That's UPS. So that's as well as a 200-day, although this one sliced through the 200-day quite a bit in the past, but it does still come into play often as you can see resistance when tested from above and support when tested from below. So we're there now, but again, this is what I'm focused on the most here. All right, next up, CSX Corp, railroad stock, another watch, rinse, repeat stock that trades pretty well to the technicals. Divergent high, short, divergent high, short, divergent high, short. And is it possible that's all you get? Possible but doubtful. Just look at the size of this wedge. Look at the scope of it. It's a multi-year trend line. Goes back to early 2016. This was a smaller wedge, and that's what you got. This was a smaller wedge, and that's what you got. So to me, this looks like it's just an initial kickback rally in correction or a bear market with much more downside to come. In fact, I can tell you right now, this would be a long-term target around 49 for CSX for me. FDX, FedEx Corp, there it is, uptrend line, well defined. Nice little, breakdown, back tested for several weeks, maybe even a couple months, and then boom, next leg down. This looks like a blow off top right here as well. And there's your breakdown, back test, and this one's been moving lower since. It's had a pretty hefty correction, but I don't see a lot in this chart oversold. Sure, if we are in a bull market with a lot more upside left, new highs to come in 2019, then this is probably a great buying up. If we are in the early stages of a bear market, expect another leg down and expect this oversold reading to, stay oversold or become more oversold in the months going forward. NSC, pretty clean chart. Again, there's your uptrend line, well defined, your divergent high, breakdown. This was more of a sideways. It was a downtrend. It was a bear market, at least a drop of 20% or more. But for a year and a half, where that would have warned you get out of the stock, stay out. And then you had a nice clean up trend line here, divergence again, negative divergence, and this one really would have paid off for a trend short trade. It took all the way down to this level, and at that point, it wasn't just arbitrary where you might want to cover or go long. You got it, a divergent low, very clean, strong bullish divergence right there. Something you do not have at this point in time. And we're in the early stages. This is the longest uptrend that we've had in years, if not decades, in this stock. And you had a breakdown, and we're back testing now. So from a purely objective lens, this looks like an objective shorting entry. Maybe not so much on the timing. Again, it's a weekly chart, so you have to go down to the dailies and the 60 minutes to hone down your entry or exit, because we could back test for weeks or even months and still roll over. So that analysis might prove correct, but it'd be painful to ride out a short, especially if it works its way higher, back testing that wedge for a while. DAL, Delta. And there it is. You can see the divergent highs in the past. You can see the corrections that followed. Here's a divergent high right here. There's your correction. And there's your most recent divergence. Trend line's not great because it's been chopped through a few times. But Delta, like a lot of airline stocks, has been a dead money trade for years. Usually airline stocks are dead money. This is falling oil prices gave them a big lift up to where they are now. But for the most part, these stocks tend to trade in ranges. And the best you can do is, trade off the top or the bottom of the ranges, or bigger picture. This is a multi-year potential topping pattern, at least range. So a solid breakdown below would probably bring you down to the bottom of this range here. That would take Delta down to around the 35 area or so. You can see the divergences again. LUV, another airline stock. This one peaked back here in early 2018, has not seen those highs since. Here's a trend line to watch. It overshot it on a momentum field overshoot during the sharp meltdown into the December lows, but it's still well below the highs. And again, mostly a dead money trade. Like I said, the airlines, they do have their moments where I'll engage those and trade them long or short, but for the most part, they've been slogging around sideways. I don't like dead money sideways trades. Try to avoid those. UAL, nice clean wedge, very clean uptrend line, no sell signal yet. This would be, again, the more of these trend lines or horizontal support levels that I'm showing you that these stocks have held for years, the more those that break down in the coming months, if that is what happens, the more check marks you get to the bear market case for the sector going down a lot further. So watch for these. If you replicate these charts and you see UAL, Delta, all these start breaking down, especially on weekly closing basis, then you have a stronger case to be made that the new bear market is underway. AAL, American Airlines. I mean, you talk about a dead money trade. This goes back to early 2014. Stock has gone. There's that red. There's the sideways trading range right here. So, like I said earlier, the best you can do with this, you can trade off the 60-minute charts and daily charts, but longer term, you can just trade the range. Sell when you get to the top of the range, buy when you get to the bottom, or be aware that it's a multi-year range. It's a powerful topping pattern. So if we broke it with conviction, that would be quite bearish and probably project down. Usually just take the distance of the range, and that would give you your rough target right there for AAL. And of course, it can go to the upside. And there's a downtrend line to watch. So if we do get some traction in the markets and in the transportation stocks, AAL is flirting right now, testing the 200-day in this downtrend line. Convincing break above that could take you up to the top of the range. That'd be a decent trade for you. If it got there, swing trade all the way, it's about a 50% return to the top of the range. Trend indicators are bearish right now, and we are coming off a weekly divergent high. The last time we had negative divergence in the weekly was back here, and that stock dropped. It fell for a year and a half, and that was probably, I don't know, I can't measure without doing this. To turn these off, tell you that that stock fell from that divergent high, dropped about 55%. CHRW, there it is, same story on a lot of these, go back. And I just want to, get impressed that these technicals do more often not play out. Divergent high, bear market. Divergent low right here, see positive divergence, bull market. Divergent high, bear market, or correction, however you want to call it. Divergent high, correction. Divergent high right now, correction. Is it over? That's the million-dollar question. But from look at this, I can't make a strong case to go long. And again, it may be the early stages of a bear market because remember, once again, all of these quote unquote corrections or bear markets I called, they were corrections within an ongoing bull market. And that's what we can't forget. If this is the beginning of a new bear market, these would be corrections. This is what a bear market would look like. Minor squiggles aside, of course.